All right, starting the webinar, and I will start the intro at 2:01. Hello, everyone. We will give folks 1 minute to join the webinar, and we'll get started. All right. Hello, everyone. Happy Friday. Thank you for joining WisdomTree's pre-election and post-jobs report, where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, Global CIO, and Kevin Flanagan, Head of Fixed Income Strategy. We like to make this event interactive, so if you have any questions to submit live, you can type them in the Q&A section of Zoom, and we'll address them throughout the discussion. As a friendly reminder, this event is being recorded. Now with that, I'll turn it over to Jeremy Schwartz to start the webinar.
Well, nothing like a slow Friday news day, Professor, to kick off our weekend. We were just talking about trick-or-treating, not too chilly. Kevin liked a little bit more chill, but markets, besides for the bond market, no chill today. So, Professor, we get your take on all that you're seeing as we go into the big election week, big Fed week. Kevin and I are here to help answer questions. Thank you all for taking your Friday afternoon before the weekend to hear from us on what's happening. We love to hear what's on your mind. So go into the Q&A box, ask us questions for the professor and for Kevin and I about our funds. But Professor, kick us off.
Thank you, Jeremy. Yeah, there's so much news in the next 6-7 days. So let's start it off. Let's talk about the employment report. So the employment report hit the sweet point. It was not that weak, but weak enough that I do think the Fed cuts 25 basis points next Thursday. I mean, we still have other events obviously going on. I don't, the election probably is undecided. It could, I'm going to talk about the election and the financial markets in just a minute. All right, so I think this was this is on the weak side. Mainly, I'm looking at the household because the establishment payroll survey certainly was distorted by the weather, primarily a little bit by the Boeing strike. But we did get a 400,000 shed from household, which is pretty much what it gained in the September report. So that definitely weakened. Although the unemployment rate remained the same at 4.1, if you take it down to the second decimal point, we actually had just about 1/10 of a percentage point increase in that unemployment rate as a result. We did have hours come off a recession low, actually, of last month, which was revised up by 1/10. I commented last month that that was a recession level of hours. Well, they revised it up a bit, and it's remained at 34.3. That's still low, by the way, and it's kind of skirts recession levels. But we've had a tendency towards lower hours, actually, ever since the pandemic. So, that just moves on that score. Wages are very much in line. I think our underlying productivity is in the neighborhood of 2%, which, if you subtract it from wages, you get a 2% inflation, maybe 1.5 to 2, so you get 2 to 2.5% inflation. It's really very much in line on that front. We had a revision downward also in the previous 2 months. Most of that was a seasonal adjustment, but the underlying job growth certainly is not looking as strong as it did in October. With all the data in. I think the Fed could go 25. I think there might be a dissent or two. I think he could be setting us up for a pause in December, depending on the evolution of the data. Now, we should, let me actually give you the data as I look at the screen right now. And then I'll talk about that. Right now, July 2025 Fed funds, which represents, because there is no meeting in July, represents the action the Fed will take next June, is selling at 384. Now, you could say, since the current Fed funds rate is 483, that looks like exactly 100 basis points, 99 of cuts, 4 25 basis point cuts. However, let me warn you, as I've said many times in the past, there is a hedge risk premium in here, which I estimate at maybe up to 125 basis point cut. What does that mean? Instead of 4, Fed funds of this level actually represents an expectation of 3, maybe 3.5 cuts. We have a total of 6 meetings between now and the end of next June to this year for first half of next year. So this means the market is expecting an every other meeting. That's one way of saying it. It could be, any combination of that, but 3 meetings of 25 and 3 meetings of no change, and in any order or combination that we see. Obviously, if the economy gets very weak and we see weakness continuing or developing in December, obviously we're going to have more. But that's all that's really there. Now, with that in mind, the normal premium of the 10-year over the Fed funds rate is 90 to 100 basis points over the last 70 years. That includes recessions when the premium is negative and the curve is inverted. If we get to a normal shaped curve, the average is almost 150 points of premium of 10-year over the Fed funds. Now, if you think, as I do, that the long-run Fed funds rate is between, let's say, 3.25, 3.5 and 3.75 rate, you're thinking that the long-term bond rate is moving into the 4.5 to 5% or slightly higher range. It's not going to happen tomorrow. Not going to happen this year. But when all is said and done, we're going to probably be settling down to a Fed funds rate that's 3.50 and a 10-year bond that's 5. And that's why, this was clearly a weak-looking report. We had an immediate 8 to 10 basis point decline in the 10-year, and now it's 5 basis points above where it was before the announcement. It went from 422 now to 435, a 13 basis point increase. Not really much news. We did get, let's take a look. We did get some other announcements that should be mentioned. The ISM manufacturing actually came in a point weak. The prices component came in a little bit strong. So what am I seeing out there in the market? I am seeing a couple things we should note. The money supply is growing again. Deposits and M2 are growing at a healthy 5.5% rate. That's not inflationary, but it is a good rate. That 5.5% is what we had for 34 years as an average rate between 1986 and the pandemic, before we flew off into 28% increases in inflation. And then we stepped on the brakes, and now we're back. Now, I say we're back. That trend is 2 to 3 months. I mean, but it's getting to be established. This is good. So no deflation really is coming from the money supply. Yes, I know they're still doing a small amount of quantitative tightening, but deposits are increasing. And that's more important. I also do not see commodity prices going down anymore. I don't see them going up. We have a little flutter in the oil market because of hints that Iran is going to do a retaliation, maybe, and that produce a little premium. Basically, sideways movements in the commodity prices. The Bloomberg Commodity Index has pretty much been sideways for 3 months and 4 months. Same with the Goldman Sachs Index. We take a look at again the ISM prices for goods at 54. That shows a slight inflation. This is a number that for quite a few months was way below 50 during the real strong tightening period of the Fed. So, bottom line is prices have gone down. On the average, they've stabilized. Still think the Fed is a little bit above its neutral stance, but not much. Maybe 100 basis points, maybe 125. Certainly not down to the 2.9% rate that the Fed put out. Now, as you know, in this November meeting, they do not put out a survey of economic projections. That comes out every quarter. I expect that our star to keep on going up. I estimate, let me even throw, I actually thought it would go up to 3.0. It only went up to 2.9 in the September meeting. I think it might jump 3.0 with how strong the economy's been up to 3.1, but that's still too low. Fed is very low, very lagged on changing its long-term parameters, which is too bad because those are the anchors to which it has to undertake its policy. All right. Let me talk about the election and what I think would happen to the market under various scenarios. Scenario one, a Republican sweep of both houses of Congress and the presidency. I think that's going to be bad for the bond market. I would not be surprised if we saw bonds spike 20 basis points. If that happens. Fear that every tax cut that Trump wants can be enacted. Now, I think the Republicans won't enact them all. I actually think the movement in the bond market is like a shot across the bow, right? Saying, hey, guys, don't act irresponsibly. You got, you have to finance $1.8 trillion worth of debt, and if you think you can raise that to 4 or 5 trillion a year, you're fooling yourself. And that's the way the bond market warns politicians and others. That is rated, by the way, now on the betting markets between 40 and 45% probability of a Republican sweep. Much lower, let me go to the Democratic sweep, particularly the Senate, which is over 80% to go Republican, but let's assume that there's a blue streak that sweeps the Congress. That would be better for the bond market, but worse for the stock market. Oh, let me mention the stock market. If there's a Republican sweep, the stock market will love the fact that the Trump tax cuts can be extended, the capital gains can be expended, not going to be a billionaire, millionaire tax. Capital gains look good, less regulation, they love that. They will not love the bond market. So that'll put a little bit of a lid on it. I still think stocks could go up on a Republican sweep. In other words, the strength of the corporate tax rate remaining low and perhaps going lower. I don't think that's going to happen because taxes have to be renegotiated at the end of 2025, but nonetheless. So I would say a Republican sweep, bad for bonds, good for stocks, but they're going to have to contend with those rising rates. We'll put a cap on how high stocks are. A Democratic sweep is not going to be good for stocks. It'll be better for bonds. A split. Republicans control the Senate, the presidency, but they lose the House to the Dems. That's actually a likely scenario. I mean, considered to be a pretty likely scenario. That will be much better for the bond market because then obviously Trump's tax cuts cannot all go through, and there'll be a check and balance, and there'll be well, you could call it gridlock, but nothing. There'll be negotiation. The deficit cannot get out of control instantly with one party controlling it. So that might be actually a much better thing for. It wouldn't be as good for the stock market because tax legislation originates in the House of Representatives. If that goes Democratic, then it's going to be a big negotiation. Certainly, the Trump tax cuts, some will expire, some will not. There'll be a big renegotiation. If you want to, I can tell you how I think each tax might go. Hey, but that doesn't happen until January 1st, 2026. Beyond it, most people's purview in the markets. So split Congress, better for bonds. Sweep, probably not good for either side because the Dems could pass everything, no check and balance. Worse for the Republican side because Trump has promised many more tax cuts. I'm not making any judgment here. I'm just telling you what I think would happen. Good for stocks on a sweep. Dems control House split. I think that could be okay for stock just because there's a lot of uncertainty out here. I mean, you see, let's take a look. What the VIX is over 20 now, right? Let me look at my screen over here. Yeah, VIX 22.2, a lot of hedging. And that's a lot of uncertainty hedging, both for what the Fed is going to do, what the outcome is going to be. If that is behind us, without a civil war starting, I mean, that's going to be good for stocks. Because when you see a high VIX, it's a lot of put buying. Now, one of my colleagues said, well, Jeremy, isn't it put buying because PE of the market is 22 times forward earnings? No, I think it's put buying because of events. That usually is an event thing. And there's lots of events. And a lot of people say, I'm not going to invest until those events clear up. Which, of course, is a dumb investment strategy because when everything clears up, you're buying at the high. But nonetheless, that is the attitude of investors over there. So, given say we get a result, no violence, everything is okay, I expect the market to move up at that particular juncture. I don't like the bond market anyways. I don't like the trends in the bond market. The trends in the stock market are still strong. I mean, the truth of it is we don't really see a rotation. We see one day where all of a sudden tech falls, some earnings disappointments, we get a surge and everyone thinks it's the start of the rotation. Next day it all reverses. I mean, it is true that, since the middle of the year, growth versus value has crept up. It hasn't broken a longer-term trend line. The Mag 7s still live. They're not going crazy, but they still live. And if interest rates are going to be high, Mag 7 doesn't care as much. They don't finance a lot with. I mean, they get discounted. Their assets get discounted, but they don't borrow at it. So their assets get discounted, but their profits are not going to be affected. by that. I mean, everyone says, well, they're really, they're long-lived assets, blah, blah, blah. And, long bond becomes important. Yeah, but their profits aren't affected. Short, mid, and small cap firms' profits are affected by the Fed funds rate. If that ain't going as low as certainly we thought it was in the summer and early fall, or right after the September meeting, when, by the way, instead of 383 as the June Fed funds effective rate, it was 303. I think it actually went to 298 at one point. Wow, that seems a long time ago. I mean, we've zipped out more than 3 Fed cuts in a matter of 2 months out of the scenario that we have. Well, I could go on any details. We had 20 minutes. Let me pause. Bring Kevin, Jeremy in, and your questions as they come through.
Professor, I wanted to ask you, we were talking about this before we went on. The 10-year Treasury yields up about 75 basis points from right around the September Fed meeting. And like you were saying, to use Powell's term, but in a different way, a recalibrating of interest rates, right, in the bond market as to this kind of different narrative we have now versus what we were talking about 4 or 6 weeks ago. And getting back to the election, like trying to tie that in as well, do you think the bond market would be viewing, I mean, let's face it, both sides really are showing, whether it's a blue sweep or a red sweep, there's going to be no fiscal discipline probably. I don't think that's
in a sweep case, but in a non-sweep case, there'll be much more fiscal discipline.
Yes, right. So my question to you would be, in those scenarios, do you think Trump's policies would be viewed as potentially more inflationary for the bond market?
Oh, absolutely.
Yeah.
But there are also more growth and more deficits and more inflationary, particularly if he goes through with his tariffs. Let me say, in reference, Kevin, to what you discussed at the very beginning, I was the one who said that when the Fed became aggressive on the downside, the long bond was going to go up. The long bond was hedging against a recession, the Fed moving too slow. When they saw the Fed recalibrate, remember, recalibration relates to the Fed funds rate, Kevin, not the 10-year.
Right.
And what they're saying is, we say that the long-run Fed funds rate is 2.9. We say we're 80 to 100% of our way towards our goals, so we should be moving towards 2.9. Now, I think it's above 2.9, but nonetheless, it's below where we are today. Now, by becoming aggressive and cognizant of that tightness and moving on the employment, the Fed has basically taken recession off the table. When I say that, obviously anything could spark a recession suddenly. It's not a zero probability, but greatly reduce that probability. That's what a lot of people buy that long-term bond for, is recession and diversification. They're not buying it if that's not going to happen. And so the rate goes up. The rate also, I mean, a lot of people are saying the bond rate's gone up because they fear inflation. That's only one of 3 reasons the bond rate has gone up. Reason number 1, taking recession off the table, huge reason for bond to go up. 2, stronger real growth. Higher real growth with no change of inflation raises bond yields. Could even raise bond yields even with lower inflation. You can't ignore all those factors, and there are others too. Obviously, fear of long-term deficits comes in also as a factor in bonds. So when we see bonds go up 75 basis points from their lows, don't say, oh, that's 75 basis point more inflation that the bond rate, the bond traders fear. No, that's wrong. Maybe it's 20 basis points on the inflation, maybe 25. It's 50 on the growth, and it's 50 on the reduction in hedge value of the long bond. And with the fear, I mean, if we were to go back when actually, even the betting markets were favoring Harris, let's say 2 months ago, the probability of a Republican sweep was down to 20%. Now it's over 40. And so the probability of not having that discipline is gone up. That fear of the deficit has gone up. So you have 4 factors raising the bond rates. Certainly, if we don't have a recession, inflation would be higher than otherwise, although not out of control. Secondly, you have stronger growth. Third, you have lower probability of inflation. Secondly, what we've seen is a greater probability of a sweep. All those are negative for the long bond.
There's one follow-up on the tariff policy and sort of questioning from 2016. They weren't so inflationary. What do you think this time around? How do you think they get impacted?
Well, he did not propose 20% across the board. It was more selective and on China, and it was going from a 0 rate. Don't forget, we've already put some tariffs on. Now, we've taken some off on other countries. But you talk about 20% across the board and 60% on China. I mean, now, it could be a lot of talk. It probably is. He wants to use the tariffs as a negotiating tool. But I'm just saying, 20% across the board and 60% on China, if that gets there, that's inflation. The dollar will rise. By the way, their dollar will rise in such a scenario because you're limiting the dollar flow abroad because you're restricting the imports. However, and this is the big factor that the market fears, retaliation. If there is retaliation for these tariffs, then you're in a different world and not a real good world, in my opinion.
So, Professor, talking once more about tariffs, and then we can move on to another subject. Is there a big difference with Chinese investment in Mexico? Can they avoid some of these tariffs now by coming through Mexico?
Well, I mean, you go from 60 to 20 if you go to Mexico. I like nearshoring. I like that idea. I think that's a play. I don't think Trump is fond of the Mexicans. So I don't know if they can escape a 20% tariff. I mean, it's better than 60. And I think the trend is nearshoring or onshoring. And that's a long-term trend. I mean, we've often talking about India, move to India for some manufacturing. Of course, Mexico doesn't have to go over the seas. It can be reached by rail, et cetera, and truck. So there's a much bigger transportation cost saving in that scenario. So yes, I still like a nearshoring play. India, Mexico. I think that I think that goes on whether he puts on those 20% tariffs or not, or 60% tariffs, because I think we want to get stuff out of China as being a sole supplier for so much of our stuff, and protection of intellectual property, which is another important factor.
Kevin, the first question that had come in, I'm going to direct the first question to you for a second, because the professors talked about rates 4.5% to 5%, not chasing duration, gave a bunch of different reasons on that. And the very first question that was written in tied to, there's been this huge move to private credit and things, business development companies, BDCs is one of those areas, MLPs, all the interest rate sensitive stuff. Any thoughts that you have? I know you've been talking about our alternative income fund and it owns some BDCs in it. Any updated thoughts on within credit and other things like that, how you'd be thinking about?
Yeah, sure. I think it's a great question. I mean, I was just in the Los Angeles area. If you want to go to one place in the US where private credit is either 1 or 2 after the election in terms of a topic people want to discuss, that's certainly one place here in the US. There's no doubt high yield and investment grade credit from a historical perspective, looking at spreads, is on the tight side, without a doubt. And so you are seeing people lean into the private credit sector. And I think based upon the comments from the professor on the macro outlook, I think credit is still well placed from a fundamental standpoint, not necessarily relative value, but from a fundamental. And that's why alternative credit, our fund, HYIN, which gives you actually access to private credit, I think is an interesting opportunistic play for fixed income, alts, whichever way you want to bucket it in your overall portfolio. Yeah, and remember that there's also in the alternative credit space, you do have a floating rate component, which I think is interesting as well. So if rates do continue to move up to where the professor was talking, you have some hedge on that you may not necessarily have in the investment grade or high yield space unless you go into the leverage loan kind of market. But once again, the difference in yield, you're talking about alt credit at 11% versus 7% for high yield. So I do think, in a long-winded answer here, that from an opportunistic standpoint for a portfolio, alt credit is an area to look at. And we've been in the space now for almost 3.5 years in what we would determine, a user-friendly ETF structure for sure.
Now, Professor, there's people keep asking about the bond vigilantes, the deficits. When do we have a moment where we start to care? Like, will they have a Liz Truss moment? You've been writing about that more and more. Give people your view on the deficits and when it
Well,
matters.
again, a Republican sweep on Tuesday could bring a little, nothing like Liz Truss. I mean, but a little warning. I think some of the creep up in yield is that fear of deficit and a Trump sweep. And again, I think that's going to be good for the economy, generally good for stocks, but comes with some other factors that may not be good for bonds. So now, it's often, let me repeat, the deficit that we have today, 1.8 and even up to 2.5 trillion, is absorbable by the world markets. If we don't go above that, I don't think there's pressure on the bond above what normal, as I say, stronger growth, normal term structure and all that. When you start going to 3, 4, 5 billion, facing what we know is the long term that gets even much worse, then you could start getting more pressure. And by the way, it is exactly that pressure that causes Congress to act. And as we know, since Congress must act, well, basically must act by December 31st of next year, that's the time, you would get a lot of action. If bond rates are high and the homeowners are screaming and the home builders are screaming and those that need long-term capital, those firms are screaming, the Fed isn't lowering more because of the long bond, etc., you will get action. Listen, it's happened in the past. It's not a crisis. In the UK, we had a 1 or 2 day bond crisis and she was out on power. I don't see that. It's going to be more insidious and slower and deliberate, but it'll pressure. And everyone will be talking about it. And the bond traders will say, and why are the rates so high? Because you're pouring 3, 4 trillion on us. I can take 1 or 2. That's my analysis.
That's a real interesting point on all that. Jar, question came in. I thought of you. He or she is anonymous. I am one of your former students, Professor. Nice to see you. But the question is, do you have a view on gold under some of those different election scenarios?
Well, I think, interesting, the professor's got this 200-year chart. He has a famous chart showing $1 in stocks, 7% a year. Gold provides inflation protection, but not much more in the long run, so less than 1% a year. But it has provided that inflation protection. So as people worry about gold, it's something to think about. I think the challenge from the professor, like just understanding, working with the professor for 20 years, it's like, well, where do you fund it from? Because, even bonds have had a better real return than that 1%. Like TIPS would give you closer to 2% today. And so, one of the things, interestingly, we did I think, informed by some of that was, well, how do you add gold without having to sacrifice anything? We added some what we call capital efficient solutions where you add a gold overlay on top of your US stocks. So you don't have to sell anything. You can have stocks plus add some gold. That's one of the things we did. This capital efficient core family that added stocks and bonds, the place with gold is an interesting idea. But for sure, that's definitely one of the things. I think gold's interesting, just short run, that Bitcoin has got all this attention. You've seen tons of inflows into Bitcoin. Gold is not, gold is hitting these new highs with basically China and Russia buying gold, but not the ETF investors. So it's just got an interesting commentary on what's going on.
It is, and I remember when, and I was calling all that inflation right in the 2020, in the year of the pandemic, and we kind of went into gold a little bit, and it just sort of sat there. And Bitcoin was the one that exploded, and I kept on saying, yeah, Bitcoin is young people's gold. People are not interested in gold anymore. So, sort of edged out of it, and people said, yeah, know what? The gold is what I want as I hedge against inflation. Here's how you to be right and to be wrong. Right on all the theory and reasons, and then just timing question. It seems like it just delayed. As inflation is going down, gold is now going up. When inflation was going up in 2021, gold was doing nothing or very little. So again, I mean, it's so hard to buy the short-term hedge. For that reason, and I mean, I think Jeremy really summarized my long-term feeling is, gold is a good inflation hedge. I wouldn't, if someone wants to buy 3-4% gold in there, I'm not going to complain at all on a wedge. I mean, even a few percent on Bitcoin as a wedge there, but as a long-term investor, it's not productive. It doesn't have the capital that produces the cash flow. So you're getting the real protection from inflation, but you're not getting the productivity that capital inherently provides investor.
We brought China into the conversation with the tariff part of the discussion. Professor, curious, seeing some questions coming in. And Jar, you're as well, because I know we've been speaking about it from an investment committee perspective. What are thoughts on China at this point?
I think China is still cheap. I mean, it went from 10 to 13 inside. I don't know if Hong Kong went the same. I mean, Shenzhen versus the Hang Seng. I mean, China is anything below 15 is an interesting, real interesting story as long as it, quote, doesn't go out of business. I mean, you don't even need the growth to get a real good return, as long as it doesn't get worse. So if you think that Chairman Xi is not going to put an end to capitalism, China looks interesting. Or strangle capitalism, point where anyone innovative is just not going to get anywhere and turns all the capital back into state-run enterprises. Very little. Already we've seen tremendous slowdown in China from what its growth used to be. It's not, it's lost the shine, and that's why it's selling. I mean, listen, China used to sell 50 times earnings, so at one point. So that's when everyone was optimistic and it was going to become the next South Korea, basically. China still has about a quarter of the GDP per capita of the U.S. If it got to be half, it would double in size. Korea's 2/3 already U.S. per capita GDP. It shows you where you could go in a Southeast Asian country. Honestly, I still personally like India. The government, the British legacy of the rule of law and the rule of democracy. Of course, those could change, and it is selling at a higher price. but also the ex-China nearshoring. I mean, India's not near, but outside of China. Can they take over some of the manufacturing that China does if Trump wins and does put a high tariff on? Don't forget, Trump put a tariff, not 60%, it was selective, on China. He has Elon Musk as an advisor. I'm sure Elon Musk doesn't like, BVD and electric cars from China. Biden kept a lot of those Chinese tariffs on when he could have taken them off. So you can see there's a bipartisan side there. China is not in favor. It doesn't seem to be getting in favor. It's cheap enough that it could pay to wait. But we know the risks.
Well, we could talk about international markets all day. There's coming back to the U.S. for a second. There's a few, and the questions have been flowing in. And so just to give everybody a sense, we're going to do another one of these calls post-election, post-Fed meeting. So if we don't get to all your questions, come back. We'll be doing another
That'll
one
be
of these.
Thursday. Is that right, Jeremy?
Yeah, next Thursday, we'll be doing another one of these calls.
6 days from now, we're going to have a review of everything that happened, Fed plus the election. So please, join us
Stay
then,
tuned.
too.
But so let me summarize like 3 or 4 questions, all on a similar topic. I mean, people have been talking about the markets are expensive. I heard you give some new data on one of your presentations recently, but just to also put to bed one question, somebody said the equity premium went negative. I know you have a lot of views on that, on how to calculate the equity premium. And then, just where valuations are, and then the Mag 7 versus traditional.
So let me quickly, because we do want to end about 2:45 here Eastern. No, equity, you got to compare apples to apples. You must compare the earnings yield on the market to TIPS bonds. TIPS are what? All right, the 10-year TIPS, I'll give it to you right now. 10-year TIPS is 2. A 20 PE is a 5% real on stocks. Now, I know it may be 22, so you're a little under that, but you're near a 3% premium on that. Also, take out the Mag 7. I don't know, what are you at? An 18 PE ratio, which is very reasonable in today's world. So, and the Mag 7 are an amazing group that keep on growing. So, how you weight those two, no one knows. I don't see any momentum start. We can have a whole session on AI and the narrative and whether that narrative is justified or not. We won't do that today, but when you look at the other 493 companies in the market, it is not an expensive market.
Kevin, any closing thoughts from you as we go into next week?
I think I've given enough that my head could be chopped off when I come back on Thursday. Dr. Siegel, you were wrong.
That's why we love
hey, I'm trying to give you my ideas. I'm trying to give you the reasons behind them. And if they don't turn out that way, then I examine it and I'll tell you right away, hey, I was wrong on this. And I'll tell you why I think I was wrong and then what does that mean to what you should expect.
And we'll just hold on tight because, as you said, there's going to be a lot of news. Professor, we have what? We have 90 seconds, real quick, 90 seconds. Can you do this? What are the chances we don't know the results on election day and we have to wait till, say, next weekend?
That uncertainty is not good. And the question is the presidency and the House and the Senate, maybe. I mean, we may. It could be so close, and a lot of states have rules. If it's in 1%, you have a recount probability. Although markets generally will react, even if it's the recounts. They kind of know it, but there's a possibility Tuesday we won't know what it is. Honestly, I think we'll know at least 2 of the 3 chambers here of government, and maybe it's the House will be probably in balance because you have to count 435 congressional districts, and some of them They're going to be slow and very close coming in.
Good stuff, Jar. On to you. Final word.
Well, Professor, thanks for staying late with us on Friday afternoon. It's gonna be fun to get your takes in real time next week. And everybody, thanks again for joining us. We'll see you all next week.
Yeah, bye.
Take care.